Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. The first couple of days of trading in 2018 are now under our belt, and much of the movement that we're seeing right now is very akin to our projections. When we left you mid-December, we talked about how this market here could very well make a potential low coming in at this time factor, and we highlighted how the vertical tangent to this arc swing was a potential time factor for a market turning point. The market has moved up from that point for about 2 to 2.5 weeks, and now we find ourselves at resistance very close to 2 standard deviations below the point of control at 354.5. Now that the market is up against resistance, we can see that the last 2 tests have been a little bit challenging for this market. We can see that these last 2 tests have been a bit of a challenge for the market as it's made its approach here, but we anticipate that we could see a bit of sideways movement for the next 2 weeks before corn could potentially get some legs. The big low that occurred mid-December was right at our 360-degree price factor at 347.5. And again, we can see how the market's moving up nicely from there. We can also see how the market came up against volatility-based support, and that price horizon was very important for this contract as it has now come up. The next 2 things now that we're looking for is around the time horizon of about January 10th to January 12th. At the end of our gray zone here is where the market looks to make its next potential turn. In the event that this market continues to move sideways going into the middle of the month, we're looking then for the next leg up potentially for the corn complex. The May contract is moving in a similar fashion, and currently right now the market's finding a little bit of trouble at the 361.5 number, which is 2 standard deviations below the point of control. Overhead, we're looking at potential resistance sitting at about 365, and so if and when this market makes it to about 365, this is where we would look to see the way in which the market responds. If it's able to find strength through this 365 number, we anticipate a good movement to the upside. Alternatively, the market could be a little bit soft near this number before it's able to make its next leg to the upside. For those that are familiar with the old market adage of old support becomes future resistance, we can see where this 365 had been support previously, and now we can see very clearly that that previous support has now become very good resistance for this market. Again, upon being able to break through this 365 number, we anticipate continued strength to the upside. July beans did end up making a very nice low at our time factor of December 22nd, but that was short-lived, only moving up for about 2 days, where shortly thereafterwards it was met with good resistance near the 995 area. Since then, the market has come back down and found support near 975, just below the point of control. And from here, the market seems to continue in a sideways fashion. The other thing that we want to bring to your attention is the way the market has been trading on either side of this upside 1-by-1 angle. And if and when this market's able to truly clear this area and find good strength above this number, it's at that point we think that soybean could potentially start to make its way higher. Until then, our bias is still for weakness going into the end of the month, and from there we'll be able to recalibrate the direction in which we anticipate this market moving in. A number of weeks ago, we shared about the importance of this 980 price level. This for us was our line in the sand for soybean, and as you can see, when the market came in and tested this area, which found very good support here, the market's bounced up and come back in, bounced and come back in a couple of times. This for us continues to be an area of very important significance. If the market's able to hold its own above 980, then this market could make its way higher. If it fails below this 980 number, then what we're looking at is the potential for a very big slide to the downside, and we can see the way in which volatility-based support bands are dropping very dramatically. This tells us that the market here is potentially in a distribution phase, and upon breaking these lows or upon breaking the 980 number, we could see a very, very fast precipitous fall in soybean before it's able to mount significant support. The 2 key areas that we would maintain on our watch for this contract right now would be that 980 number once again down below, and overhead would be looking at the $10 mark. The side that breaks first over the next 2 weeks has a high probability of continued action in that direction. So these are the levels that we would have on our watch going forward for this contract. Wheat futures has strung together a series of up days that is consistent with the move that we're looking for with regard to the divergence trade that we long had been sharing about. The market had been broadcasting that it was due for a nice move to the upside because of the nature of the divergence that we had seen, and that has finally come to fruition. We can see the very nice move from the middle of the month for this week contract coming all the way through into today. And now we're very close to that minimum price objective that we had talked about at 445 for this contract. Just below, we talked about how once the market's able to break through the 360-degree number at 424, that this is where the market would find a bit of obstacle, and upon being able to break through, would lead to the potential of moving upward nicely. Right now, this 445 number is now the key area for this contract, and we could find a bit of softness as it approaches this area for a small pullback. But going forward, we anticipate continued strength, especially with the recent weather reports that we've been seeing out of the plains. Long before any of these weather forecasts had been in play, we had long been sharing about how the market was due for a nice move to the upside. So it's very nice to see the way in which these recent weather reports are complementing the projections that we had had. We can see how the market is now touching volatility-based resistance overhead, just shy of that 270-degree mark. And upon being able to break through here, the market should see very nice clear sailing overhead. We will leave you with a look at the US dollar. And the last time we discussed this chart, we gave you two main areas to look at. Those two numbers were 93.40 down below and overhead at 94. Our suggestion was that the side that breaks first would in all likelihood have very good follow-through with a bias to the downside. We can see clearly here that the 93.40 number is what broke first, and the market has been moving down since then. We have now touched our minimum price objective of the 360-degree mark down below at 92, and this market looks like it's poised to continue lower and potentially reach down to about 91 or potentially as far down as 90.5. We'll continue to monitor this, but you can see the way the market is trading here. This pattern that we're looking at is a bearish sideways pattern that is prone to weakness to the downside. The movement that we would expect to see here is the nature upon which that this market has made a move coming into this sideways congestion here is what would potentially be repeated on the flip side, suggesting that this market could go down as far as $90 before finding a bit of support. On the weekly chart for this US dollar, we can now see exactly how these areas are coming to fruition. Our A or 1 level now is potentially confirmed. Our B leg to the upside now has found very good resistance. And now the market's moving down to what we're calling a potential C or 3 leg on the way down, with a target potential coming in right at volatility-based support at $90 on the top end of this volatility band. So everything appears to be coming together very cleanly for the US dollar index. Not to mention the rise in cryptocurrency perhaps is putting a bit of weight on the US dollar itself. We'll continue to monitor the way in which this continues to trade, but for now we're looking at a downside target perhaps near the $90 mark. Thank you so much for joining us for our market update. Look forward to touching base with you next time.